If you are investing in some financial products, such as stocks and funds, you may frequently get reports about the performance of some funds. If a fund manager says that his funds can get an annual return of 10%, did you ever think there might be a sample selection bias for this result? Survivorship bias is a typical sampling bias, which means the sampling data set is only counting the surviving or existing products and neglect the products which have been ceased or stopped. There is a famous story in World War II which is a typical example of this bias. The United States Air Force found that once a bomber has returned from a task, it gets lots of bullet holes on its wings, tails and body. So, most people thought that more armor was needed for those places to protect the planes. However, Mr. Abraham Wald raised a totally different idea. He thought that the conclusion is only based on the bomber planes which returned to the base. Those planes which didn't get a chance to return have not been calculated. He mentioned that some parts such as engines should be the place to apply armor instead of the wings. Most planes which get hit on engines went down and didn't make it back to home. Let's go back to the fund annual return example. For example, a fund manager is managing the following funds. If the report only calculates the funds which are still active, it will get an average annual return of 10%. However, if those funds which are closed due to poor performance or low demands are also added into the statistics, the annual return will decrease to only 3%, which is 2/3 less than one having the survivorship bias. The report creators may deliberately or inadvertently introduce the survivorship bias to make the report look better. Compared with the popular survivorship bias, another side of the bias is the reverse survivorship bias. Although that bias is not a popular one, it also may affect our investment decisions when we do research for the financial market. For example, if the small cap stock index is staying at the low level, can you make a decision that most small cap stocks are not performing well? Of course not. The truth might be, those small cap stocks which have good performance are quickly leaving the small cap index because they are growing bigger. Those remaining loser stocks are still small and staying in the index. So, when we do study on the stock market, we need to try getting rid of those biases as much as possible to get the best data set. Thanks for watching. If you like the video, please hit the like button or subscribe button for more interesting topics.